Welcome to Alux Life. Let's make better financial decisions and live a luxury life.
Welcome back to the deep dive. Our mission today is, well, it's pretty simple. We are decoding the 5 master scripts of personal finance. These are the powerful ratios banks use to decide your fate loans, interest rates, all of it, but they never really explain them to you.
Exactly.
So forget just checking your credit score. We're giving you the key. Okay, let's unpack this.
I like to think of it as gaining X-ray vision into your own finances.
X-ray vision, yeah.
We're moving beyond, just your past behavior. We're focusing on how banks predict your future affordability and their own risk. Understanding these 5 metrics is everything.
Okay, so let's jump into that rejection scenario right away. You have someone with a great salary, a CIBIL score of like 780.
A great score.
And they get denied a loan. How does that even happen? Isn't past behavior the whole point?
That's the common trap. CIBIL tells the bank how you behaved. FOIR, that's fixed obligation to income ratio, tells them if you can actually afford a new loan today.
So it's about today.
It measures how much of your gross monthly income is already going to fix debts. Think car EMIs, personal loans, even credit card minimums.
So if I earn a lakh, but half of it is already spoken for.
You're in trouble. Precisely. The gold standard for banks is an FOIR below 40%.
And above 50% is a red flag.
A huge one. They label you over-leveraged, but there are fixes. You can close small EMIs, add a co-applicant to boost the income side of the ratio.
Or just take a longer loan tenure to lower the new EMI.
Right. It's all about managing that number.
Okay, so that handles debt risk. What about the bank's risk? Let's talk LTV, loan to value. Why won't a bank just give me a 100% loan on a house?
It comes down to one simple concept: skin in the game.
Right.
LTV is the percentage of the property value the bank is lending, usually 75% to 90%. That down payment you make is their margin of safety.
So if I default and the market crashes, they're still covered because of my initial chunk of cash?
Exactly. And you can use this a lower LTV, so you bring it down to 60%, means you're a super low risk customer.
And that's when I can negotiate for a lower interest rate.
That's your leverage right there. And on the flip side, a really high LTV often forces you into buying expensive loan insurance. It's a hidden cost.
Okay, now for the one that drives everyone crazy, the credit card paradox. Here's where it gets really interesting. Why does my CIBIL score sometimes dip, even if I pay the bill on time, every single month? It feels like I'm being punished for no reason.
It's the CUR, Credit Utilization Ratio. The bank reports not just if you paid, but how much of your limit you actually used.
The formula being balance divided by limit.
Yep. And if you consistently use more than the magic number is 30%.
30%, okay.
The bank flags you as credit hungry, someone who seems reliant on debt, and your score takes a hit for it.
So even if I pay the full bill, I shouldn't let the outstanding balance go over 30K on a 1 lakh limit.
Here's the pro hack. Banks report the balance on the bill generation date.
Not the payment due date.
Correct. So if you have a big expense, just pay down the balance before your statement is generated. The credit bureau gets a report of low or zero utilization, and your score stays safe.
That is a great tip. Okay, let's switch gears to wealth building. Every agent loves to say, your money doubled in 5 years. You're saying that's a bit of a lie.
It's not a lie, but it masks the truth. That's where CAGR comes in.
Compound annual growth rate.
It smooths out all the market ups and downs and shows you the real average annual return. Doubling your money in 5 years sounds amazing, but it's only a 14.8% CAGR.
Which is still good, but it's not doubling. It gives you a real benchmark.
You need to make proper comparisons. Comparing that volatile scheme against a stable fixed deposit. Always ask for the key AGR.
Finally, the big one, the repo rate. We see it in the news. RBI hikes repo rate. But what does that actually do to my EMI next month?
It's a direct chain reaction. The repo rate is what it costs banks to borrow money from the RBI.
So if their cost goes up?
Your cost goes up. It's the economy's main brake pedal to fight inflation.
And you said banks have a sneaky way of handling this. They increase the tenure.
Yes, very quietly. They might extend your 20-year loan to 22 years without you really noticing.
And that costs a fortune in extra interest over time.
It can cost you lakhs. The guru advice is always this: proactively call them and choose to increase your EMI instead. Take the short-term hit for massive long-term savings.
So we've covered 5 huge tools for financial mastery: FOIR, LTV, CRR, CAGR, and the repo rate. So what does this all mean?
It means that being passive in finance is expensive. Your wealth doesn't just depend on what you earn, it depends on how smart you are with leverage and risk, using these very ratios. You have to be proactive.
And our challenge for you today is to do just that. Calculate your own CUR and FOIR right now. Which one of these 5 factors is secretly costing you money? And what's one single change you can make today to start reversing it? Go master your script.
That's a wrap for today. Don't forget to like, subscribe, and hit that notification bell for more tips on mastering your finances. And always remember, I want you to take better financial decisions.